Welcome to another episode of Outlook Money Investment Made Easy webinar series. This episode is spearheaded by ICICI Prudential Mutual Fund. And today's topic of discussion is exploring investments through sectoral and banking ETFs. I am Kundan Kishore, your host for this session. And I am delighted to welcome Mr. Chintan Haria, Head Product Development and Strategy, ICICI Prudential Mutual Fund, and Mr. Mohit Gang, CEO and co-founder Moneyfront. Welcome to both of you, sir. Mohit, I'll begin with you because you are directly facing to investors. So if you can just help our viewers to understand what is the importance of investing in sectoral and thematic investment. I mean, if you could just explain to our viewers the importance of sectoral and thematic investing.
Right. Thank you so much, Kundan, and it's great to be speaking with you and Chintan. Look, I think honestly, sectoral fund is part of tactical allocation of an investor to my mind. Honestly, when you are done with your strategic allocation, which means when you are done with your basic needs of investing, or when you are done with, in terms of Maslow's hierarchy level, when you are done with the hygiene level of your investing, that's when you try something special and you try something different to add a flavor to your portfolio or to add some significant amount of alpha or risk to your portfolio, right? If I were to explain it in a very layman term, when you are completely satisfied and you are daily having your dal, roti, chawal, everything, that's when you want to go for something exotic and something different. So that's when you will try some different flavors, maybe a pizza, pasta, burger, something to just change your mood and change the way you are eating. So that's like having a sectoral fund in your portfolio. When you're done with the basics of investing, which is your large cap allocations, your mid cap, small cap, flexi caps, everything in place, that's the first criteria. The second criteria is that when you yourself are completely plugged into the market and you are aware of what is happening. So today, if I were to buy a banking fund or an IT fund or a pharma fund, any kind of sectoral theme, I should be aware, or I should be somewhere linked to it to be kind of taking an expert call on it. Otherwise, I'll let it happen through Chintan and some able fund managers who will themselves keep changing between the sectors because that's their job. They daily track the markets, they daily track what sectors are doing well. So it's not a job of either an advisor or an investor to try and enter into a fund manager's territory unless I have some expert knowledge of it, unless I work for a pharma company and I know the internal basics of a pharma sector, or I have really clued on to a particular sector and want to take the flavor, or I believe that the success story of our country will rest on a particular theme. Let's say it could be manufacturing, it could be make in India, it could be IT or something. And I really want to have a larger pie of that in my overall allocation to meet my financial goals. But just a word of caution here, these are high risk, highly volatile funds, can deliver high returns. Entering is easy, exit can be extremely tricky, and only professional investors who really are tracking it should get into it.
Chintan sir, could you please explain to our viewers how can one use ETFs for investing in particular sector or themes?
So the way Mohit sir has explained, why is it important and what are the risks? Today, unlike say 5 years back, we have a lot of options for investors to invest in sectoral ETFs, right? So way back, probably many years back on the active side, a bouquet was built around technology funds, banking funds, infrastructure funds, FMCG funds, pharma funds. But on the passive side, which is the ETF side, we probably in India did not have, because ETFs in India weren't as popular as they are today. As the popularity of ETFs increased and investors wanted to create full portfolios out of ETFs, which like Mohit bhai mentioned that you first create a base, right? So in the base, you have either the large cap indices or the diversified flexi cap indices or mid and small cap, whatever is the base in the proportion that you create. And then India being endowed with various leadership sectors, right? We all know today we are the second largest in cement, largest in steel, second largest in steel. We are the third largest in auto. Pharma, we are the largest exporters. IT, we are the largest exporters. In the banking sector today, we are one of the strongest banking systems. So with so many sectors for investors to choose from and invest, now on the passive side also, we do have investment avenues, and which we've built over the last 3-4 years. And if you see, right from pharma, healthcare, IT, private bank, financial services, FMCG, consumption, infrastructure, you do have a lot of options in the thematic space for investors to create the portfolio out of. So clearly today, if you look at the risks and rewards, what essentially happens is sectors have their cycles. We saw pharmaceutical sector do exceedingly well between 2010 to 2015. 2015 to 2019, it did not do well. Then COVID happened. 2020 to 21, mid 21, it did exceedingly well. Now, after 1.5 years where market has done well, but pharmaceutical has consolidated, maybe that can be one sector which probably can do well for investors, and those who have risk appetite can do, look at it. Autos did well, say 2 years back, after having underperformed for almost 5 years from 2017 to 2022. Beginning, autos did not do well, but then last 1.5 years, autos have done exceedingly well. So you do have a scenario wherein the risk reward can be meaningfully larger. In cricketing terms, if I have to say, you do need test match players to hold the match together, but then you need the run scorers or the fast run scorers to take you to the next level. And that's where the sectoral ETFs help you to generate higher returns if you get the timing right. And like my friend Mohit mentioned, if you get the timing wrong and you invest at the wrong time, you can lose a lot also. So that is a specified skill. If you understand the sector well, you can take the advantage of these sectoral ETFs. Thank you.
As Chintan Bhai explained that sectoral is completely, it's a very cyclical in nature. So what is your experience so far with investors?
Look, Kundan bhai, ऐसा है कि in India today we have almost 128 schemes on the sectoral side or the thematic categorization of mutual funds. And the total AUM today, you will be surprised, is 1,86,000 crore across these sectoral funds. And that's the fourth highest category under the equity belt. So the kind of AUM which is pouring into the sectoral side of funds is humongous. And I'm sure Chintan Bhai will vouch for that fact that there is enough amount of appetite which investors are displaying. I think there are 2 or 3 reasons for it. Number one, I think as investors mature along the investing cycle, most of us have experienced good returns over last 5-10 years. जिनको उतना experience हो गया, they have seen the cycles, they are comfortable with their large cap, flexi cap, mid cap allocations, and to add that extra flavor, now they are going for sectoral funds. That's point number one. Point number two, with I think Chintan also alluded to, that India remains a global outperformer relatively, and there are many specialized zones or sectors which are emerging now, right? So it is not just about pharma or IT or banking anymore. It is about some specialized niche themes, and you will be surprised the kinds of themes which are floating around. There is a logistics funds available, there is a manufacturing fund available, there is a Make in India fund available, there is a water consumption fund available, and so on and so forth. The exotic themes are just coming up, right? There was recently a defense fund, and plethora of these kind of things are entering the market to give investors a new flavor. And investors are also lapping up because they want a new flavor, and B, they are also very comfortable with these growing themes in India, which are empowering the growth of this country ahead. So we have seen good amount of flow. However, it always comes with a word of caution. We have also seen investors lose a lot of money in these kind of funds if they have not actually entered at the right time, or they've got the cycles wrongly.
What kind of investors go for this sectoral and thematic investing? Like, hardcore retail investors or HNI segment? I just wanted to understand from you, which are the, what kind of investor typically invest in these sectoral or thematic funds?
Larger value ticket comes from HNI or family offices because they are predominantly savvy and track the markets independently and comfortable with the cycles. However, we have seen a lot of young investors these days who follow new age digital platforms coming up, but just by seeing 1 year performance. And that's actually a very wrong trend which is happening in the industry, to be very honest, and I want to call it out. We ourselves run a technology platform, but it's very wrong to enter a fund seeing just 1 year performance. And what happens is, whenever you compare 1 year performance or 2 year performance, you'll always find a sectoral fund beating the normal funds. That's some sector would have outperformed, right? So कोई cycle में IT अच्छा करेगा, कोई में pharma, किसी में banking. You will always find a sectoral fund topping the charts rather than a large cap or a diversified fund, and that allures a young investor who's just entering on a digital platform. He sees the 1 year return, 2 year return, and he just enters into it. So these are small tickets, but a lot of new folios are coming in from that zone also, and there's a strong word of caution on that's not the right way of investing. You follow your asset allocation, follow the basic principles, and allocate your monies for long term. and don't go overboard on these kind of things. So yeah.
Chintan sir, I would like to ask you, what are the popular investing theme? I mean, especially through ETFs, one can invest.
Yes. So just to take a cue from what Mohit Bhai mentioned, in 2018-19, Brazil did exceedingly well. We saw money going into Brazil funds. In 2018-19, 19-20, we saw China doing well. We saw money going into China. 2021, we saw, I think, tech doing exceedingly well. We saw money going into tech. So fully agree with Mohit Bhai that looking at the past returns, we've seen many investors investing in sectoral or themes. Which obviously then leads to the pain later on. So that is one word of caution with data as we see it. As far as popular investing themes in India is concerned on the passive side, clearly banking being more than 25%, 30% of India's general diversified sector, and it being the largest sector. It is said that any industry or any country, for it to grow, the first thing that grows is its financial services or the banks. And to that extent, India being now more of financialization, or India moving towards more digitization and financialization, banking becoming stronger with the consolidation. Clearly, that theme is a popular theme. A large part of the money which resides in sectoral funds is lying in banking or banking related financial services, extra related themes. The other is, of course, IT. No surprise there. When I say IT, I also include not just India tech, but the international technology-led ETFs in India, which are popular, essentially because of the way in the last 10 years, the big tech, so to say, the global big tech has caught the imagination. In fact, we all are probably using big tech in everyday, day-to-day life, and to that extent, a large part of the money has gone there. So that is another popular. So banking followed by probably big tech, and Indian IT is something which is popular. Apart from that, we have seen auto getting popular recently, pharma getting popular, because obviously 140 crore Indians with higher purchasing power and better access to medicines, the pharmaceutical sector should, which already has had a 2 or 3 decade growth, can potentially also grow along with the GDP. So that's also something which is getting popular. And we've seen public sector enterprise-led companies in the last 1.5 years. So again, in terms of the trend, if you look at it, the best performing sector of 2022 was public sector banks. So public sector banks led the growth, and it was significantly higher than, but that may or may not be the right space to invest in today. I'm not sure. But public sector in general has caught the attention, not just because of the defense fund or not just because of the fact that some of the PSU banks have done well, but in general, the entire central public sector enterprise and the PSU pack in general has or was extremely cheap 2 years back. And now, after having performed well, people are probably catching fancy to that particular theme. So we've seen these themes basically do well, and based on whatever is the investor's risk appetite, they can play. But the good part in India is no matter which theme you take, if you have, like Mohit Bhai mentioned, long-term time horizon, there is very less likelihood of that theme not growing ultimately, right? So be it infrastructure or pharma or FMCG or consumption, everything in 5, 10, 15 years will be larger than what it is. The markets will have their ups and downs, but if you stick onto an investment and invest systematically and smartly for the long term, where you invest would not matter. How much return you make will differ, will definitely change, but you are probably likely to make money if you have the patience and you don't enter at the absolute wrong time, in terms of when any theme is extremely hot or any sector is extremely hot. 1999 tech, 2008 real estate and capital goods, 2020-21 the big tech or the tech. You need to avoid those and you should be fine.
So, sir, actually, I just wanted to understand from you. Actually, typically, what happens when the sector has gone up, then that sector get the attention of investors. By the time when the sector is in downturn, nobody just look at those sectors. So, in that case, I mean, what should be the criteria? How one investor can spot the opportunity in a particular sector?
So my experience of 18 years in the market has taught me that market is bigger than all of us. So predicting which sector will do well is difficult, but there are certain checks and balances which you can have in place. One is the sector likely to see a turnaround because of either government investment or private investment, or in general, the business turning in favor of the sector. Now, there are certain sectors which are structural, there are certain sectors which are cyclical, and each one of them have their nuances. So as investors, of course, if you are doing sectoral investing, you need to master that particular sector's variables. So if you look at tech, for example, what is happening in US or Europe in terms of tech outsourcing and the budgets there, and that will impact in terms of what are the returns that our potential Indian companies which are in outsourcing will get. You need to have a view on currency also for that matter when it comes to tech, and more importantly on the growth outlook. And the last part and the most important part is the valuation. So if the starting point of valuation of any sector is extremely expensive, then you know for sure that that is the wrong time to invest. And hence, look at the valuations, look at the business cycle, and then you'll know that, okay, this is the right time to invest or not. For each of the sectors, the variables are different, and that is where it takes time, it takes energy, and that is why you have professional advisors like Mohit Bhai or professional money managers who do the job of picking the right sectors and stock. But if you are interested in any one sector, which you follow closely, you understand, you could be into the pharma sector and you understand closely, you'll know exactly when the pharma sector is turning based on what you see. And that is the time where you can take advantage. So more often than not, it's common sense or what you see. Like autos, for example, post-COVID, we knew autos would probably do well. We knew we could figure out that hotels are going to see a good time, right? Hospitality or hotel industry, including aviation, will do well. Not all of these have an investable universe in the passive side, but you knew that, okay, for example, if autos do well, you can participate in it through auto funds if they're available, be it active or passive. So I think common sense, and the one thing that if something is too hot in terms of euphoria and valuations are expensive, then probably you should avoid it. And the general rule, it's not a cast in iron and stone, but general rule is if a sector is too expensive relative to the wider market, you're probably best avoided investing in it. Thank you.
Mohit Bhai, would you like to add anything here?
I do completely agree with Chintan Bhai, but what we do, I'll just quote a real life thing from how we approach these kind of scenarios. देखिए, Chintan Bhai and the entire mutual fund fraternity are experts, right? They have that grip on the market in terms of tracking the sectors, tracking the movements, getting the right timing in terms of cycles and other things, right? But retail investors, it's extremely tough to get it right. And we have seen more often than not, people tend to get it wrong because they get drawn by last performances and which never work in terms of investing. So our approach has been fairly simple. What we typically try and do is we try and avoid sectoral as much as possible, but get investors into passive investing through Nifty index funds or Nifty ETFs, right? Now, just to give you the overall composition of Nifty again, and I'm sure people here know it, 37% or 38% of Nifty is financials, right? Around 13% is IT. And 12% is energy. You have autos around 6% or something. So typically when you're buying Nifty, you're buying everything. You're buying the best 50 companies in the country. You're buying it in a passive way. So obviously you're going the low cost way. You don't have to actually worry about what sector is outperforming, what is not outperforming. It automatically adjusts over a fairly long while. It will adjust in the Nifty composition also, if a particular sector keeps underperforming or something like that, but you get a representation of all the sectors. To all the investors out there who fairly get confused in terms of what sector to pick, what timing and other things, then you simplify your investing approach and just go for a plain simple Nifty. It could be Nifty 50. If you want risk in your portfolio, you can even go for a mid cap index or a small cap index. And there are many factor based investors also, or factor based investing philosophies also, which are available in an ETF format and both in a fund format today for investors to simplify their investing journey. So my submission always has been keep sectoral very low. Take it for a flavor if you're really confident, if it meets your goals. Take it for a flavor, 5 to 10%, at best 15%, but predominantly make your portfolio out of index funds or ETFs, which are Nifty ETFs, Nifty mid caps, Nifty small caps, and so on and so forth.
So, Chintan sir, I would like to, I just want to get into this ETF part. Typically, what is the difference between, sector fund and sectoral ETF? How these two are different, and why one should invest in sectoral ETF rather than sector funds?
So, Kundan Bhai, basically, be it the sectoral funds which have existed for a long period of time, you have their history, you've seen the ups and downs, so you can actually make out what has happened with that sector or that sectoral fund. It is essentially generally active funds where a mutual fund manager is taking the buying and selling calls based on the universe of that particular segment, which is the sector. In the case of ETFs, which is, let's say, IT ETF or banking ETF, whatever is the composition of the benchmark, that composition of the benchmark, the endeavor of the IT ETF is to have the same composition in the same stocks, same weights, and you will basically get the sector as a whole. There will be no stock picking, there will be no changes in weights, etc. So in some sense, if the sector does well and these weights do well, you end up getting the benefit. There may be some stocks which may have lesser weight in the benchmark, which can actually have a higher return potential. That is the job of the active fund manager. So in sectors or themes, you can not necessarily point out whether the active will do well or passive will do well, because it totally depends on that particular fund manager, whether he's able to shift and maneuver the portfolio and get the right mix. However, if you don't want to rely on the fund manager picking whatever, you want to go by the sector and the biggest weights being the largest point of your portfolio, then you go with ETFs, because in ETFs you'll get the largest free float market cap having the largest weight, and typically in sectors you have the big 2 or 3 contributing significantly larger. So generally in active funds, you will not find very large concentrated positions at the top, even in sectoral funds generally. In ETFs, by definition, if the top 3 or top 4 account for, let's say, 40, 50, 60% of the portfolio, then you'll get exactly that. So it totally depends on the investor's choice. There is no right or wrong. You can rely on the fund manager also if you get the theme right. And if you don't want to rely on any specific fund manager, you basically invest in the ETFs where the stock selection, the weightages are predetermined. You know exactly what you're going to get. You know that this is what I'm getting, these 12 names, 10 names, or 15 names I'm getting in this way. I'm happy to invest in that. And that is what you'll get. Because in the active fund, the fund manager can buy, sell, purchase, sell, change the weights, etc., based on their expectations of return and risk. So both are good. Choice is yours, which one you pick up. And hopefully, if you get into both, you get the best of both worlds if you get the cycle right.
So Mohit bhai, what I could understand from Chintan bhai has mentioned that typically the sector funds are actively managed and these sector ETFs are passively managed. So there is a risk of call getting wrong by the fund manager. If a fund manager had taken a particular call on a particular stock or particular sector, especially particular stocks, but here that probability is 0. The fund will invest in a similar manner as they will completely mimic the benchmark, correct? So in terms of risk profile, I think sectoral ETF is less riskier than the sector funds.
देखिए कुंदन भाई, इसमें there is one difference which I think investors should understand. A sectoral ETF will also have a sectoral FOF, which means on that ETF there could be a fund of funds also, or there could be an underlying fund also. So same ETF is available in a fund format also. Okay. And what Chintan bhai was alluding to was actively managed sector funds, which are thematic in nature, and there is an active management, right? So we are basically talking passive versus active. Passive can be bought both in ETF and fund format. Those are two different ways of buying the same and. Now, answering your question, yes, you can get the calls right and you can get the calls wrong. Both can happen, right? And I'm sure Chintan bhai knows it much better than what I can even speak about. He has years of experience behind him. There are times when even the best brains can get the calls right, calls wrong. And there are times when most of the fund managers in Indian industry have actually got it right? And that's the long-term track record. They've done, the performance speaks for itself, right? Now, look, investors have to make a choice. If you are passive funds, actually, there's this famous quote about passive funds which says that passive funds is not about trying to go for average returns. It is just not believing in magic, right? So it is about saying that, okay, for a fairly long while, I'm happy with average because average is good. Beating the benchmark is a humongous task, and I'm sure Chintan bhai can speak about it. As markets mature, as economies progress, as you see multiple cycles, investing for 5, 10, 15, 20 years and decades thereof, consistently beating the benchmark is not easy. It's absolutely tough, and it's somewhat magical in nature. Right? And even if you see a recently released SEBI paper, a consultation paper on total expense ratio, SEBI kind of brought out this point themselves that for last 10 years history in Indian markets, 40% of the funds have beaten the benchmark, which also means that 60% have not beaten their benchmark over a 10-year cycle, right? So there are some who beat, there are some who doesn't. it all depends on investors how they assess a particular fund manager, his philosophy, his past track record, the fund's performance, and everything. I think a proper mix is the answer. There are few zones and areas where you need to go for index, you need to go for ETF because the cycles have completely matured, like perhaps a large cap category. There are few zones like sectoral funds, small caps, multi caps, where a fund manager can really add and generate a lot of value and generate a lot of significant alpha in the portfolio. So I think they're still in an Indian context, the choice would be going with an active philosophy, right? So it's a good mix which one has to create in the portfolio. There's no right or wrong answer at all points in time. A healthy mix is what is required for a good portfolio.
Sir, as you rightly mentioned about expense ratio. So Chintan bhai, I would like to ask you in terms of cost and liquidity, where they fared? I mean, sectoral ETFs.
So I think in terms of costs or expense ratios for the ETFs in general, they are low cost, and to that extent, for any investor looking to invest in the markets, they form the most efficient way of investing without having to take those individual stock calls, right? And in terms of efficiency with which the asset management companies endeavor to have the similar portfolio, run it with lowest tracking error, and provide liquidity on the exchange for investors to ensure that they get the right NAV, or they get the NAV which is closest to the price at which the market is buying. So the ETFs give you the advantage of buying and selling in real time, and the asset management companies, through the authorized participants, ensure that the liquidity on the exchange is good enough for investors to basically participate at the right price without having too much of impact cost. The infrastructure is improving, the effort by the asset management companies is there. It's like a virtuous cycle wherein more investors will lead to better liquidity. We are trying to probably improve the infrastructure as much as we can in terms of having liquidity on the exchange. And I think many of the AMCs are working towards ensuring an ecosystem wherein people are comfortable. The expense ratios are low. The expense ratios is not a problem. India being such a small market in ETFs, yet the expense ratios are more or less comparable, if not lesser, than the Western markets, which have probably much billions of dollars in AUM and ETFs. So expense ratios are low. India in general is a low expense country. And in terms of liquidity, in terms of ease of investing, I think many Indian investors are already used to investing in the stock exchanges. The stock exchange mechanism is quite comfortable. Now with T+1 settlement, it's all even better. India is probably the only country with that kind of efficient mechanism. So I think investing is easy. It is low cost. It's just about trying to get more investors to probably create that network effect in the ETF space. And we hope we're able to reach there in the coming future. Thank you.
As you rightly begin in the beginning, you have mentioned that exit from this sectoral ETF is important, at the right time. So would you like to add, because you both have given very much convincing reason to invest in sectoral ETFs. So now I would like to ask you, suppose if somebody has invested in sectoral ETFs, how one can assess that now it's time to just get out of that particular ETF or particular sector? How one can access that?
It's a tough one, Kundan bhai. Honestly, had I been good at answering that question, I would have advised more of sectoral ETFs to my clients. But unfortunately, I'm not. Look, I think investors have goals, and if your goals are aligned to a particular fund, then if you are nearing that goal, if your financial goals are getting met, then obviously that's one reason why you should exit and you should encash your positions. Right. Second thing is, if you have made enough amount of returns, and by enough I mean you will always have a band in mind that okay, I want to make when you're getting into a sectoral, it's more like a, as I told you, it's more like a tactical allocation. And with tactical allocations, you typically will have some limits. Saying I want 20% return out of this investment, or 15% or 25%, everyone will have a cutoff level. And when you're nearing that cutoff level, I think perhaps it's time to take a call on that. Sometimes you can get wrongly stuck in a cycle. And at that point in time, patience is the biggest virtue you should follow. Not that sectors are bad, not that pharma is bad, or FMCG is bad, or IT is bad in India. I'm sure at times everyone performs over a 10-year cycle, if you see, each of these sectors have delivered phenomenal returns for the investors. So even if you get caught in a wrong cycle, I think that patience becomes a good virtue in these sectoral funds. And you have to ride out the cycle, which perhaps can be a 5-year story. And as I told at the start, that 5 years is a reasonable time frame to be investing in a sectoral fund. In that time frame, I'm pretty sure that in India, you will see cycles playing out for various sectors, and you will get your returns. But one of the key reasons why one should get into it is if you want a significant position in a particular sector, right? So if you want, look, Infosys and TCS, by virtue of their index weights, are available in all funds today. They are available in all large cap funds, active funds, passive funds, everywhere they are, right? Similarly with HDFC Bank and ICICI Bank, they're available in every single fund, every single scheme of the country. Unless you really believe that there is something phenomenal which is going to happen and I want extra weightage on these things, right? If you go for a banking index fund or a banking sectoral fund, the weightage together for Infosys and banking for ICICI and HDFC together will be almost 70-75%, right? So if you really want that significant chunk of these two, then you go for that. And similarly, Infosys and TCS together will constitute bulk of the IT index fund, right? So if you want even higher exposure into these two than what a normal fund gets you, then you go in for these kind of themes. So you have to be very certain and confident कि मुझे इसलिए चाहिए. And then when you see that, okay, these stocks have also played out, which are the bulk of these indices, then you might want to take a call. If you think HDFC and ICICI or Infosys and TCS, for let's say example's sake, have typically outperformed or over-delivered in last 1 or 2 years, and you think there is 6 months of dull period or 1 year of dull period for these particular stocks lying ahead, then you might want to take a call to exit out of the index, because index predominantly is these 2 or 4 stocks kind of, right? So these are few reasons why one can look at exiting sectoral themes.
Chintan sir, I would like to ask you about the taxation part. Is there any additional advantage of investing in these sectoral ETFs?
So clearly, Kundanji, from a taxation perspective, equity ETFs are similar to equity investing, which essentially means that less than 12 months, it is short-term capital gains of 15% plus some surcharges, and more than 12 months, it is 10%. I mean, if you book gains, you have to pay 10% on those gains plus some surcharges. So equity ETFs are treated as equity itself, and the rules of equity taxation apply. On your previous question, if I may just add to what Mohit Bhai mentioned, you did mention, Kundanji, that buying, what we've explained. So buying is a science. You can put some science to buying in terms of investing, right. But in terms of selling or in terms of the sell decision, our experience has taught us that it is always good to think in terms of switches. So instead of, let's say, if you're invested in, say, banking, and if you find today, is pharma better than banking? Maybe, maybe not. Or is banking got more expensive than the market and pharma is less expensive than the market? Should I shift there? It's always the next best alternative decision, which allows you to make the right decision in terms of switching. If you can't find a good switch, then probably you are in the wrong place in terms of selling. Then maybe cash is the only king, rather than thinking of anything else. If everything has become expensive, then of course cash is king, as they say. But otherwise, thinking in terms of switches, especially in the sectoral sectors, will probably help you garner a slightly better edge than your fellow investors. Thank you so much.
Mohit, would you like to add anything here?
No, I think it's a fantastic point. Honestly, I think investors have to be nimble enough to figure out that yes, one sector has played out its due course, and perhaps other is under has underappreciated. Or as Chintan Bhai mentioned at the start of this conversation, that if you see the average of the sector vis-a-vis the broader market, and if you see there is some amount of discount which is available on the multiples out there, then perhaps you might just want to switch and move on to the next sector. As I said, it's a tactical allocation, so you have to be nimble and quick enough to keep changing and rotating between this.
We have come to the end of this episode of Investments Made Easy. Thank you, Mohit, and thank you, Chintan Bhai. Let's hope you enjoyed our conversation today. Please don't forget to share your comments and feedback on this episode. You can also share your suggestions and questions at letters@outlookmoney.com. We will be back with our next edition soon. Till then, stay safe, stay invested, and keep rotating the sectors.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.